Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance. Here are your hosts, Lucas Muzialski and Leo Severino.
Hello everyone and welcome to the third episode of the Wall Street Lab podcast. Today we are jumping into the topic of hedge funds and we have a very special guest. Leo, why don't you tell us a bit more about who we're talking to today?
We had the pleasure of interviewing Markus Storr, who held various positions over the years, including working for Robert Flemings in London, which is now part of JP Morgan. And for the last 12 years, he's been working for FERI, where he's currently the head of hedge funds. FERI is a German asset manager with around 30 billion euros in assets under management and one of the biggest investors in alternative investments in Germany. You will notice during the interview that Markus is a very outspoken, high-energy guy, so we really enjoyed interviewing him, and I hope that you enjoy it as much as we did.
Yeah, he doesn't really need this introduction, I feel. We can just jump straight into the interview. What do you think, Leo?
Yeah, I think so too. I think people are tired of listening to us.
Yeah, so without further ado, here is our interview with Markus Storr.
And just one last thing before we move into the interview. The content you're about to hear is for information purposes only. It constitutes the opinions of individuals and therefore should not be treated as investment advice.
Hello, Markus. It's a pleasure to have you here on the show. Thank you for being here, first of all. We're sitting here at FERI today in Bad Homburg. It's a beautiful day outside. How was your day?
Perfect. It's Friday and the week is over. And from that perspective, markets are not too shaky. It's all pretty good.
Great. Okay. Let's start off with the first question, which is, how do you tell people what you do? People who are not into finance at all, how do you explain what a hedge fund manager does?
I mean, first of all, we are in Germany, so that task or even answering your question is even harder because Germany is certainly not well known for being a financial place or even having a vast majority of people with skill set or a deep understanding of financial or capital markets in general. When it comes to hedge funds, this obviously extrapolates into something which is even beyond what people know when it comes to equities or bonds, real estate, private equity, which is something which you are able to understand with a certain will and effort. Hedge funds are the wildest animal out there with virtually no restriction on what they can do with regards to asset investments, with regards to leverage, with regards to whom they employ based on what kind of skill set, and in addition to that, where they come from, which language they speak. So the degree of freedom of what these guys can do is extraordinary, which to some extent is the main critical point where politicians, social media coming up and blaming these guys for a lot of things because of that degree of freedom. On the other hand, for an investor who understands and who values these kind of degrees of freedom at a very high level, which we do, it's a paradise, because assuming that these guys are not fraudulent or neither behave reckless, it's the best world you can be in, because if you, I mean, it's like in your personal life, right? If you have a high degree of freedom and your wife and your mom and your whoever relatives leave you rather alone than kind of pushing you around, you're in the best place. So this is virtually how you should start if you have somebody in front of you who is rather limited in understanding capital markets. The degree of freedom, this is personally the thing which I think is the best to describe what the hedge fund world is about. Yeah,
right. So why don't we start off at the beginning? Could you tell us how was your start in finance? How was it to transition from the German education system into the world of finance?
I can tell you, this was not at all a straightforward way. When I finished my A-level, I decided to take a year off. So what I did is I basically went around, took a couple of kind of short-term jobs, I mean, in hedge fund world, you would say raised some money, and then immediately invested it into in a couple of flight tickets, in a couple of rail tickets to Spain, Italy, and Greece, and it's quite common in the Anglo-Saxon world to take a year off after A level and to travel around the world. In Germany, everybody looked at you and felt like, "Holy cow, is this correct?" It was. So I took a year off, and subsequently to that, I decided, as I've always been interested in capital markets, and even in parallel to my A level, there were a couple of they were called kind of paper portfolio games with the local Sparkasse, and I always intended that as a team leader, etc., etc. So subsequent to that year, traveling in Europe and visiting certainly interesting places, I decided to take up an apprenticeship, which was with the local Volksbank called the Berliner Volksbank, which is the largest kind of Volksbank in Germany. And I got a 2.5-year contract. Due to my results, I shortened that down to 2 years. And subsequent to that, I said, certainly that's not it. I'm not going to die in one of the local branches selling saving books or opening current accounts. And that's when I started studying at the Humboldt University in Berlin in April '93. Finishing my university degree in August '98. And throughout my studies, I got to know a couple of people in investment banking. In addition to that, the former president of the Deutsche Bundesbank, Professor Helmut Schlesinger, was my professor at the Humboldt University. So I took 2 semesters of monetary policy, which was very interesting. First of all, shocking to me that only 13 students felt like that this is of interest, which again tells you that probably central bank policy is not something which people are too interested in. Nevertheless, I got to know my future boss there, and his name is David Marsh. He used to be a journalist with the Financial Times, now running a very successful think tank type of business. And he got me over to London for 2 internships in '96 and '97. And subsequent to my degree, when I graduated, he called me up and asked me if I have already a job. And I had 3 job offers with Commerzbank and with 2 other asset management managers in Germany. And he said, no, wait a minute. And he wanted to know all the details, and obviously launched a takeover bid to my existing contracts, which finally led me to joining Robert Flemings in August '98 in London. And then I spent 5.5 years in London before I moved back to Germany.
Robert Flemings was acquired by JP Morgan.
Robert Flemings was a blue-blooded Scottish investment bank. I mean, in England you say merchant bank, with a very strong base in Asia called Jardine Flemings, and very research-driven as well as M&A driven. So a lot of transactions, and that was acquired by Chase Manhattan, and Chase Manhattan was acquired by JP Morgan, and that was in late '98, which obviously led to mergers, and they had an asset management arm and M&A arm. But it was the start of my career in investment banking almost 20 years ago, which was interesting because on a Friday at noon, because it was a Scottish merchant bank, you had the Piper. The building was designed so it was central, like an atrium. So 7 stories, and the Piper came around at 12 o'clock noon and started piping. And you could hear this in every single room of that bank, which was funny, but nevertheless, that was a Scottish bank, so you have a Piper at noon on a Friday.
That's great. So how does working in London compare to working in Germany, especially in the investment banking industry?
Obviously, I mean, this is a question where we could talk for ages. Let me break it down because I've been asked that question many times. You have that private element, which includes commuting, social life, wasting time on the tube, and in certain other transport-related elements. And then you have the business element, which is who do you meet? What kind of people do you meet? And then certainly what kind of business do you do? Size-wise, transaction-wise, international-wise, etc., etc. Let me start in Germany. Germany, again, is a country where financial business in general is perceived as not really value-adding. I'm exaggerating a bit. When you wear a dark suit in Germany and you're in the financial industry, you are perceived to be not too trustworthy. Let's put it that way. That obviously has accelerated since the financial crisis. And I think this is completely unfair, particularly nowadays. Still saying that obviously through the financial crisis, we had a lot of crooks out there in the banking industry, which did a lot of things wrong. But, and this is a big but, they did the things wrong, which most of the time was not a criminal offense, but rather reckless behavior. And that was due to limited regulation. I mean, these investment banks coming into the crisis had virtually a Wild West greenfield playing field where they could do whatever they want to. So this is Germany, where the perception of the financial industry is rather diminished. Everybody who works for BMW, Daimler, or designs part of a car are respected more than us being in a dark suit. When you come to London, obviously based on the history and based off the size of this business, I mean, the city of London employs around 500,000 people. So the acceptance of this business in the society in general, similar to New York, is just an element of the society. So people in dark suits are not viewed as, oh, be careful, these guys are dangerous. They're just normal, even in the local society. When it comes to the business, obviously London is, beside New York, the major financial hub. So all transactions are a multiple of what we do in Germany. In addition to that, London is the financial hub when it comes to FX trading. I mean, 60-70% of all FX trading is done through London. In addition to, obviously, the general skill set, if you have 500,000 people, you can do much, much larger transactions. So you can compare it, but they're all starting from a different point.
Yeah. And now you work in Germany. You are head of hedge funds here at FERI. How does that compare to what you did before in London?
When I was working in London, I was a research analyst. I was responsible for the coverage of European equity or European stocks, focusing, or better, designing mechanical engineering products, whatever that meant. Or even car manufacturing, anything which is capital goods related. So I was broking into the hedge funds, which we are now investing into. So obviously you had the situation where the hedge fund called up and said, okay, do you have a interesting pair trade where I could go a stock long and where I could go a stock short? And actually we had special agreements with hedge funds where we sent them our best long and short ideas on a weekly basis, and they paid us for that. Coming back to Germany, FERI is investing into hedge funds for almost 20 years right now. Started with private wealth, hence ultra high net worth individuals, and more morphed into institutional. So I've seen both sides. I used to broke into hedge funds, telling them which stock could go up and which stock could go down, and now we are judging if these guys know which stock could go up and which stock could go down, and hoping that they do the right thing, whoever they get advice from. I mean, not for me anymore.
If you could go back, would you do something differently? Would you maybe stay in London, or would you come here to Germany?
That's a very good question. Because there are elements in London which I love, which I like a lot. I mean, beside all my friends, or a lot of my friends and my wife's friends being in London, I think I wouldn't change what I've done, because if you come from Germany, you have a different work perception. Excuse me if I'm offending any UK person listening to this in the future, but the precision and the punctuality, all these kind of stupid stereotypes which we as Germans get kind of thrown at, I think they're pretty true. So working with this kind of background in an environment where risk-taking, deciding at an earlier stage than a German decides on, because he hasn't analyzed 100% but only 95%, gives you a good mix of working in London. I wouldn't change anything. What I would probably do is I would probably move closer to the city of London next time, because commuting in hour 10 is a hell of a lot of things, and I can't tell you how many times I missed to get out at my tube station because I fell asleep coming back from the city at 10, 11 in the evening, and I took the tube, the district line, down to Richmond, and I woke up because the guy came around and woke me up and said, "You're either drunk, certainly you're not right here." So I switched the platform and only once passed again around my tube station. So I wouldn't change things from a conceptual point of view.
We could go a bit deeper into this. If you could tell us something about the work-life balance in London. How does this famous investment banking, sleeping under the desk work?
No joke. We slept under the desk. We did that. Obviously, if you are in the investment banking industry, and from a time point in terms of how much time you have to invest, it hasn't changed. before the crisis and after the crisis. You have to work a hell lot of hours there. And that is required. If you don't do this, you are out, and there are 100 people outside who want to do this. And I think this is a fair concept, because everybody who picks that up knows precisely what this is about. You certainly are in the office at 6:30, 7 o'clock, depending on what you do. M&A bankers usually are later, but everything which is capital market related from a trading point of view or from an investing point of view has to be in the office at around 7. In particular, if you're trading European assets, you lose an hour. Europe is an hour ahead, so you have to be in the office at the same time, which means you are based in London, which is an hour early. At the same time, you are in the office certainly until 8. And when there are certain transactions which you might be involved, it's 10, 11, 12. And we slept under the desk. We had our sleeping bags, and we slept there. Not every day, certainly, but twice a year, you spend the night there, and you didn't take a shower. It's not an element of life which you admire throughout the year, but it could be part of the concept. Now, people come up and say, yeah, there was this unfortunate element that people get mistreated in the city of London for working hard, sleeping less. That might be the case. What or why do you do this? Obviously, there is compensation for that. And compensation at the end of the day is reputation, interest, global scale business, and certainly money. Because obviously in the investment banking industry, you are well paid. You're not at all that well paid as you used to be before the financial crisis. I mean, that has been scaled down to some extent with completely acceptable arguments, but you still earn a lot of money in the investment banking industry. So from that point of view, coming back to Germany, where working hours in principle are much shorter. Having said that, there are some businesses in Frankfurt which have to go the similar mile, which means same hours. But in principle, investment banking in London and New York is more intense. It's higher paid. And to be honest, I mean, everybody has to decide on its own. I mean, I talk to people where we thought of employing them, and they come up with this work-life balance issue at the age of 26. I mean, if this would be my son, I would probably ask him, okay, then become a plumber or do something else. But the point is, if you are starting your career and you want to be in investment banking, you have to take this as an opportunity, which means you suffer to some extent. You have less time to go out, to do sports, etc., etc. But that mitigates away in a couple of years if you do it right. But at the end of the day, it's everybody, or the younger generation has to decide on its own if this is a route they want to go down, or if they want to work in a rather more cosy environment from the very beginning.
We see a lot of our friends now doing internships in London are talking a lot about how you have to be the first in the office, you have to leave the last, you have to be the one who pushes through to get the work done. What would you recommend is the best practice for people getting into finance, starting out in the investment bank? Would you recommend additional exams like CFA, Kaya? Would you recommend running a startup on the side or just working hard? What would be your recommendation to the people who are trying to impress the people who they are working for?
First of all, the question, the way you ask it, is exactly the way you have to think as a graduate. Let's call it a graduate, okay? Leaving university. And basically, all things you mentioned, not in aggregate, but in an individual amalgamation, could make sense. And let me just pick two of those. Internships. Internships are very important. Internships are always wrong at the wrong time when you're a student. You have a semester break for 3 months and you feel like that's it, off to Spain, off to Italy, wherever. And now this is time for internships. If you want to go down a route and you want to be first, because when you finally apply with an investment bank, you are one of 1,000. So you want to make sure that you are in the first row. And you don't get into the first row because you shout the loudest. It's you hand in documents and people look at your marks, your university results, your university, where you're from, and certainly what kind of internships you have, beside the references, etc., etc. So internships are important. When it comes to getting into the industry in general, At the end of the day, it's down to the character. You have to push it. You use the word push it. You have to be first and you want to be last. At that point in time, you want to be first, you want to be last, because you are supporting people. At that point in time, as an intern, you are not running the show. You're supporting senior management. You're supporting senior analysts. And if they ask you to calculate something, to build an Excel spreadsheet, to do a regression or whatever, you want to be first providing him with this, because at the end of the day, he will recognize that you supported him. And that might lead in a year's time, when people are looking for new junior analysts, that they remember you and that they might offer you a job and not anybody else. So from that perspective, internships are certainly helpful. With regards to running an entrepreneur business in parallel to the university, I think this is beyond the internship. If you are able to do this because you have a smart idea or you have the 27-hour day, please go ahead, do it. It's certainly appreciated if you do things in parallel to the university. And the third thing, which is obviously is postgraduate, let's say, knowledge building, I call it that way, because there are certain differences between the courses. The CFA is certainly a very well-respected postgraduate program. Most importantly, because it's internationally well-known and it is internationally accepted. So it's not like a local German postgraduate program, which probably in London or New York nobody would know. But if you do the CFA in Frankfurt, it's the same as if you would do it in Bulgaria or Romania or in London or New York. So everybody knows that you've been through this pain of 3 years CFA. So this, for example, is one thing which I appreciate, because it tells you a lot about the personality. Everybody has to do the same thing, and if he's done it in parallel to the university, that certainly shows you that this guy is able to go the last mile. Yeah.
So what do you look for when you're hiring people, when you're sitting in the interview room? What questions do you ask a potential job candidate coming into your company?
I would go one step back. How do we select who makes it into the interview room? Okay.
Yeah.
And this pretty easily starts, I mean, probably it's a Germanic approach, but it's the motivation letter. I mean, just simple as it is. A motivation letter. People applying for a job send a motivation letter, and then they attach references to it and their final remarks from university. This is something which I look at. My mom always told me, watch what you write and how you write it. And you don't believe how much rubbish you have in motivation letters. Wrong sentence, just purely wrong sentences, comma at the wrong time, misspelled words, just simple things like that. This is something which I certainly look at. It tells you a bit about that personality, because if you write a letter and you send it off without having reviewed it at least twice, because you know it's going out to a head of a division or a department where you want to have a job, then this is this kind of, yeah, I've done it, send it out, might work kind of behavior. And it's not, I want this job. Let's read it 5 times. Let's send it to my mom. Let's send it to my sister. She's a German teacher. Can you read that and make sure that there's no mistake, and because I want this job? So this is the way I read a motivation letter. And honestly, I read these motivation letters, let it be in an email or let it be in paper form. This is what I read first. And then I go to university results, and then I go to references / internships. A lot of people talk about language, which I think is important, but it's only down to English. If people speak French or Spanish or Portuguese or Mandarin, it doesn't really matter. Financial industry is English. In Germany, obviously, it helps if you speak German as well. So once you made it into the interview room, then obviously it's down to a lot of other things, which is how do you behave? Do you answer in a straight form? And obviously, do you pass the tests? I mean, we set up assessment centers. We let people run through case studies. Every person obviously through the same case study, so you can compare. But this is then a normal procedure. But to make it into that room, I think this is ever more difficult, because you can sidestep that path so easily.
Does any cover letter stand out in particular? Was there a cover letter that you just got and you thought, like, this is the person I need to give a job to?
I remember that there was a student, I can't recall if it was a Chinese student or a Turkish student, I can't remember, but there was a cover letter which was precise, which was not the typical, I think that my skill set, which I learned at university, might help me to enhance your team's performance while I'm still able to learn capital markets, and at the end of the day enables me to be successful in my future life. If you write this in a cover letter, send it to me. Thank you very much. No.
Okay.
Be precise, be personal. Tell me something different. I mean, what I just, in a nutshell, rephrased is the usual cover letter, which I can fully understand, because at the age of 25 or 26, when you graduate, this is how you feel and this is how you think. But the more, and this is the way I read it, the more different you are, the better it is. Talk about your extracurricular skills. If you're a strong sports guy and you are close to the national team, or you do something extraordinary, I don't know, if you a BMX biker and you want to do this very professional, tell me in one sentence about that. You know what I mean? Be different, because at the end of the day, you will have 1,000 people left and right, and 980 will have the same cover letter.
Okay. So I've seen you around the office for a while, and you seem a pretty intense guy. Was it the way you started off when you started off working, or was it something you developed over time?
I think it's a personality thing, and certainly I've been intense to myself and to everybody around myself ever since the beginning. I used to do a lot of sports. So you are in a competitive environment where you have to be intense. If you are doing sports, let it be soccer or basketball, or even coming back to be intense to yourself, doing triathlon, you have to be intense, because you have to tell yourself, if you're alone on the road running a marathon, that you will survive, and you want to survive at a good time. So you have to be intense to yourself. And if you're in a competitive team, soccer, basketball, you have to be intense not only to your opposing team, but also to your teammates as well, if you have some lazy guys in the team. So that in itself requires a certain intensity. If you then distribute this into work, you have to be careful, because obviously at that point in time you're responsible for people, and that's where you have to treat people properly. And treating doesn't mean like telling them off. It's most of the time guiding people without telling them what to do. And from that point of view, I think intensity in life is certainly helpful. There are other people being happy to sit on their couch at 4:30 p.m. every day. So be it. Not with me.
So what did you do for sports?
I played soccer for a very long time. I played basketball. I played table tennis, and this was all in the school team. At a I would say pretty high level, and then I did start finishing some smaller triathlons. Obviously, to do a full triathlon wouldn't work time-wise. I mean, there are still guys which I admire a lot doing this in parallel to their work, but I only did the small ones. Obviously, riding the bike or better bicycling, which was an element of difficulty for me, because I was raised in West Berlin, where obviously the likelihood of hitting a wall after a couple of kilometers was quite high. So you couldn't really race that much. So if you went out and you raced 100 kilometers, which is normal kind of time on a Saturday or Sunday, it was hard. So when the wall came down, that was much easier, because you could easily go outside Berlin. The streets were not that well prepared after 40 years of communism in the GDR, but nevertheless, you had that's what I did, triathlon and consistently sports 7 days a week. That is something which I recommend to everybody, to my kids and to everybody, because not only that it makes your body fit, and as we all know from the old kind of Greek and Romanian people, a good body is good for the health, but it frees up your mind for whatever you do.
Good. Let's switch up gears a little bit and talk more about hedge funds. You are now the head of hedge funds here at FERI. Could you describe how your typical day looks like? Is there something like a typical day?
If you're in the office, it is not a typical day. It differs if you're on the road seeing managers, because then you have a typical day. In the office, it differs from obviously, you have structures, you have meetings which are revolving on a monthly basis where you look at investments. We are invested in a couple of dozen hedge funds on behalf of our clients, mainly institutional clients in German-speaking Europe. So we monitor the funds which we are invested in. At the same time, we obviously do due diligence on new funds. In addition to making sure that the reporting to our clients is done on a monthly basis, that if clients call in and have certain questions or have recommendations on other funds, obviously there's an intense communication with the client base. So in the office, I wouldn't say that each day is the same. That differs if you're on the road. If you're on the road out there and you are on due diligence trips, then each day more or less is the same. Not each meeting. Each meeting is different, but the day is the same. What does that mean? You start early in the morning. You have between 2 and 4 meetings a day. Wherever you are, let it be in New York, in Shanghai, in Beijing, we are invested across the globe, in Tokyo, in San Francisco. But you go out and you have these due diligence meetings, let it be operational due diligence or investment due diligence, where you question the manager, where you question the risk manager. And that has a certain structure because you have to ask the right questions, you have to find the right things, you have to look at the right spots, and you have to do this in every meeting, depending on the strategy, on the hedge fund, in more or less the similar way. So you have to be very structured if you're on the road, and it's very intense because you have sometimes 2 weeks being on the road. In the office, it differs. And obviously in the office, you can structure your day more freely than being on the road because these kind of due diligence trips have to be prepared with 3-4 months in advance.
So here comes a question that you probably perfectly prepared for after doing all the meetings with potential investors. How is the hedge fund industry doing right now?
It's, I would say, in heavy waters right now for different reasons. And when I say, or when you ask about the hedge fund industry, then we are talking about the broad average of indices of around 10,000 funds out there. Obviously, there are a lot of funds performing extraordinarily well this year, but on average, and this is something which the media looks at, which potential investors look at, and this in the year 2016 looks rather poor with regards to performance. Now we can talk about why that is. I'm convinced that one reason why the hedge fund industry is performing poorly this year is that a lot of people have piled too much money into the same strategies, and the hedge funds have piled too much money into the same investments/securities. We've seen that in particular in the equity long short space. We haven't seen such a bad year for equity market neutral, systematic equity long short trading funds. When you look at merger arbitrage, when you look at commodity related strategies, then this year is a very good year. So the broad question, which is always asked, in particular in the media as well, how are hedge funds performing, is, and excuse me for that, probably not a very correct question, because the hedge fund industry can be divided down into 15, 16 underlying sub-strategies. And each strategy is driven and is dependent on completely different factors. Let it be macroeconomic factors, let it be central bank policy, interest rate, FX, you name it. So to ask the question, how are hedge funds performing in itself is a misleading question, and I think a wrong question, because you always have to, and that obviously needs a certain preparation with regards to digging down into this, you have to look at the underlying strategies. And this again, coming back to the year 2016, on average, if you look at the broader hedge fund industries combining all strategies, it looks poor. If you look at some underlying sub-strategies, and if you pick those strategies or the managers in those strategies, you actually could perform quite well. And some of our portfolios are nicely in positive territory. When you look at the larger indices out there, they're all pretty negative. 2, 3, 4%, which is not good for hedge funds. But again, as I said, you have to pick the right manager and you have to pick the right strategy. So to say hedge funds are performing poorly is right on average, but not in general.
Could you elaborate a bit? What is the difference between fund of funds and hedge funds themselves?
The fund of fund model compared to what we do is the business model of setting up a portfolio, structuring a portfolio, and then trying to distribute the fund of fund vehicle to other potential investors, which means you are creating a portfolio ex ante, which you believe suits a potential client base, and then you go out and sell it. That business model suffered a lot since the financial crisis because people bought into fund of funds, which was more or less suitable to, one size fits all, which doesn't work. What we've been doing ever since we invested into hedge funds, and I joined FERI in 2005, so since 98, 99, is to build bespoke portfolios. So what we do is, from an economic point of view, we build fund-of-fund portfolios because we invest into single managers and combine them to one portfolio for a particular client. However, and here comes the difference, in a bespoke way. So pension fund A comes up and said, I would like to invest 50 million into a hedge fund portfolio. And then we build a hedge fund portfolio out of single managers, but not just based on what we think is good. It's more important, and this is always the starting point, to understand what is the structure of this pension fund's allocation across all other asset classes. If you have a good relationship to your client, they tell you which equities they're invested in, private equity, real estate, fixed income, FX, if they have an overlay, if they hedge their currency, etc., etc. And based on that, you should then be able to allocate to certain managers, building a portfolio which hopefully fits perfectly into the overall pension fund allocation to mitigate some risks in the existing allocation, but most importantly, to make sure that it's not in any way adding to the same risk, but diversifies. This is very important. So just to build a portfolio from scratch and then to open the door, run out and try to sell it, this is certainly not a business model which I believe is good. And at the same time, it's not the business model which we've been doing ever since I'm here and even before.
So what is better? Is it a great strategy and a bad manager, or a bad strategy and a great manager?
Let's give you some numbers, because obviously we try to do, which is hard, calculate the attribution analysis of what we do. Hence, as we invest into strategies, and within those strategies, which we think might perform good, we try to find the best managers. So if you want to get the double whammy, you find the best strategy and you find the best manager. Yes, this is Christmas and your birthday on one day, which not a lot of people have. But to answer your question and to look at our own figures, to find the right manager from our own attribution analysis is ever more important than to find the right strategy. And you can basically say probably 25% of your attribution is strategy and 75% is manager. Have we been in a situation where we picked the wrong strategy, but luckily had a good manager? Yes, obviously. This is somebody is kind of saving your bum for you being wrong on the strategy. Have we been absolutely convinced that there's a strategy performing extraordinarily well and we found a bad manager as well? Yes, that happens. But again, coming back to the general due diligence process, to find the right manager based on your own due diligence, let it be qualitative, quantitative, all the checks you do is more important. Because even if you're right on the strategy, you might miss a point in a manager, which leads to a significant drawdown. Let it be that they are not sticking to their risk limits. Let it be that they are going with their leverage beyond what they should do. Let it be that they run the portfolios too concentrated on what they should do in this kind of strategy. And if you miss out on that and you pick the right strategy, you need 2 weeks and this fund is in a drawdown. So the manager selection itself is more important than the strategy. However, you want to be right on both.
So you get a lot of different pitches from different managers.
A lot of rubbish, yes.
A lot of rubbish. How do you cut through the bullshit and just
Absolutely.
look at the manager and say, this is the one we want to have in our portfolio?
Yeah. The best start of a meeting is always, good evening, Mr. Storr. Can we go through the presentation? No, we can't. Because this is a well-prepared stuff and I won't let you be in your comfort zone. And I certainly don't let you run through your 35 pages to read me through that. Obviously, there are a lot of things you have to ask, but most importantly, what you have to do is you have to prepare yourself. before you visit these guys on site, you have to prepare yourself. And that means you have to read through everything. You have to read through the PPM. You have to read through the due diligence questionnaire. Obviously, you do the quantitative analysis. We do a lot of factor analysis. We do a lot of regression analysis. Hence, we try to explain most of the performance of a manager. Because at the end of the day, if you can explain a lot of the performance through certain statistical techniques, you are able to understand more what's driving the performance. A lot of people talk about they want to see the alpha generating manager. I mean, there might be somewhere behind the hill, and certainly in history there have been a lot where you could not explain the entire performance of a manager. But at the end of the day, you want to understand what these guys do. Why? Because in the future, if they do things which you don't understand, you are in trouble. Because I don't want to have a performance which I don't understand. So looking at these guys, talking to them, it's important that you are prepared, in particular if you visit them on site. You have to check what they do. And checking what they do means not sitting in a meeting room and letting them go through a presentation stack. You have to go to their desk and you have to ask them, can I sit in your chair? And they look at you, why? And I want to see where the sheets are you talked about in your presentation. Can you pull them up? And that's when they suddenly get shaky, because they're probably not prepared. That's when they say, okay, all sheets are interlinked and we feed them automatic from daily database coming in every morning at 8 o'clock. So pretty easy things to say. You say, can you please open the Windows Explorer? Yes, thank you. Can you please sort for date last saved? Can you please sort for hour last saved? And if you see that out of 50 Excel sheets, the top 2 are saved this morning, the next 10 are saved last Monday, and the remainder last month, it's time for Starbucks and a coffee.
That's great. What is the weirdest strategy that you've seen in a pitch for a hedge fund? We've seen some crazy stuff over there.
Yeah, I can tell you. And that was before coming into the financial crisis, there was a fund investing into old instruments like Stradivarius and all this kind of stuff, which I think is highly interesting. I can't remember the redemption terms of that fund because I couldn't remember the exchange where you trade Stradivarius. So that was something seriously weird. Obviously, if you are a long-term ultra high net worth investor and your daughters play the violin, then this might be of interest to you. But this is certainly not something which we could invest to. I would say until 2 years ago, everybody who came up with an Iranian fund investing into Iran would probably be looked at in a certain manner. But as I said initially, I mean, the degree of freedom in the hedge fund world is something which investors should appreciate and should be not afraid of, because this enables people who are trustworthy, who look after the investor money in a fiduciary way, who are well educated, not reckless, and stick to what they say. If you offer these guys a very high degree of freedom of where to invest according to what they announce their strategy to be and what they've written in the PPM, that's where you want to invest. And there are a lot of other weird things which you obviously don't want to touch.
Hedge funds are considered an exit route for many bank professionals. How do you look at this? Is this a viable career choice straight away out of the university, or are hedge funds something like, I'm done working for a bank, I'm going to move to the hedge fund?
No, it's not. You can, I mean, obviously we're talking in the year 2016 where hedge funds are sucking up a lot of investment bankers, a lot of people being made redundant by banks because the business model of an investment bank is virtually broke due to over-regulation. But in the year 2016, the majority of people joining hedge funds are certainly former bankers. Let's put it very broadly, bankers. Obviously, there are people joining directly from university. I mean, it's a variety of approaches where you can join a hedge fund. But as we speak, a lot of banks are losing talent because the over-regulation and the destruction of the bank business model in itself is making people move to hedge funds, in addition to asset management industry in general, or setting up their own businesses. When I say the over-regulation, obviously you have to keep in mind that banks are not only making money from structuring transactions or trading They are making money from taking deposits in and lending them out. If you take deposits in a low yield environment and you lend it out, you're in trouble as well. So it's a double whammy. I mean, the bank business model is broke, not only due to regulation, but also due to the low yield environment. To join a hedge fund as a graduate is also a very good option. And I know a lot of people, even students of mine, are helped to get jobs at hedge funds. Obviously, we talked about the skill set. We talked about CVs. We talked about cover letters. We talked about skills in general. So there are two routes. But at this point in time, hedge funds are employing a lot of people from the banking industry, and I can see why that is. The regulation on hedge funds, and now we come to a very sensible topic, is still very limited, which a lot of people, in particular the politicians, hate because they think that the hedge funds will finally blow up the world. That is certainly not the case, because every hedge fund manager has the vast majority of his own wealth in his fund. So he will certainly make sure that he doesn't blow up the fund, because otherwise he blows up his own money. And most of the time, mom and dad and friends are invested as well because they trust the son. So these guys will certainly make sure that this is not the case. Coming into the financial crisis, not all the traders, but a lot of bank employees, in particular on the trading desk, there was no clawback. You got your cash bonus and off you go. There was no clawback 5 years back, so you behaved in a certain way, not reckless. There was a limited regulation. So this playing field within an investment bank coming into the crisis was, and I'm exaggerating, not being regulated, having the luck to manage other people's money, which is the balance sheet money of a bank, and a trading book which was probably way too big for what you should do. That has obviously all been cracked down, which I think is reasonable and okay. In a hedge fund, being not regulated, the picture is different. And that's why a lot of media coverage says the shadow banks and the hedge funds, they will kill the world, blah, blah, blah. No, because they run their own money. And if you run your own money, you behave differently. If you're a trader on an investment bank in the year 2003, you didn't run your own money and nobody looked what you'd done. So that's the big difference.
So we'll shift gears now a little bit, and we'll jump into some more personal questions and daily routines and things that you do to improve your day. What is your favorite quote? The one that helped you on the way, or one that has been on your mind recently?
One quote which always jumps through my mind is, I touched on that earlier, which is, a proper mind needs a proper body. So, you have to work on your skills, which means if you're lazy and eating chips and drinking Coke and all this kind of fizzy liquid out of a can stuff, that is not helpful. But at the same time, you have to obviously develop your mind as well. So,
if you could outsource any daily activity, what would it be and why?
That is a hell of an interesting question. Obviously, the most precious element, I have 3 kids, the most precious element I have is time. So if you could call the Almighty and ask him to add another 2 hours to the 24-hour day to make it 26 hours, I would outsource that responsibility to him. Having said that, everything which is stupidly time-consuming, that's what I would outsource. Commuting, getting stuck in a traffic jam. I don't know if you guys remember that movie with... what's his name? That American actor, where he gets out underneath the bridge, leaves his car and goes absolutely bonkers because he got stuck in the traffic jam again. Michael Douglas, yes. So getting stuck in traffic jam, wasting time. This is terrible.
Who is someone you find to be successful in life in any way that you find appropriate?
My mom. 3 kids, raised us on our own because unfortunately dad died early, all on her own, sent us to university, and as far as I can judge, we all call kind of pretty okay people.
What are 3 pieces of advice that you would give to your younger self?
Think twice before you answer. Think where you spend your time. Because, as I say, sometimes you waste time, which you should not. And this is very philosophical here, but obviously you have to prepare yourself where you want to pay back, whatever that means, okay? Let it be to your parents, let it be to society, let it be to younger colleagues, whatever. some element of do you pay back sometimes? Whatever that means. That is an advice you have to give yourself. And this is not in any way monetary. It's rather in a philosophical way.
What is something that you changed your mind about recently?
Recently? Not to buy a new car. Come on, it was not my own decision. My wife told me off.
That's great. What was the car? We can tell you if it was a good decision.
I forgot.
Oh, no, you didn't.
I probably did not, but I think I did.
Why do you live where you live? Besides the job, are there any factors that contributed to your decision to move to Frankfurt?
No, to be honest. I mean, Frankfurt is the financial center of Germany. If you want to do international financial business, and I'm not talking about only investing money, because if you're a very wealthy person, you can invest your money from wherever you are on the globe. But if you want to do international business, you need an international airport. You want to be short in terms of commuting to that airport, and you want to fly everywhere on the globe pretty quickly. You need to be in Frankfurt. And that brings us to Bad Homburg, because if you have kids and you want to spend your time not somewhere kind of being caught up by concrete wherever you go in the city center, that's when you move to the outside. It's like in New York. When you live in New York, you move out to Greenwich or to Rye or Connecticut. If I could live somewhere else in Germany, I would certainly live somewhere else and not in Frankfurt, or better, close to Frankfurt.
Here is one on the verge of finance and personal views. How do you feel about the mentorship relationship in finance? Do you think that having a mentor who will show you the ropes and guide you through the world of finance is more important than attending seminars and learning on your own? Or do you think it's over-exaggerated?
No, I think it's not. Education, university, skill set, postgraduate degrees, etc., they are certainly a must, and this is the base. To have a mentor is, I think, very, very important. I had the luck of having, I wouldn't call a mentor, but somebody who believed in me, probably because I did a proper work. When I mentioned that gentleman from Robert Flemings, who basically offered me a job subsequent to my university degree, which is not that often that you leave a German university and join investment banking immediately. You have to have certain links, internships, etc. But to have a mentor on top of a good education and a certain will and personality, strengths, etc., is very helpful. Because as a young person, when I was early 20s, I mean, what the heck did I know? I mean, probably I believed that I know a lot, but I certainly did not. So to have somebody to shield you off from guys who want to make sure that you fall off the cliff, to shield you off from speaking too fast at a point where you shouldn't speak, and. In addition to opening some doors to offer opportunities, that is certainly very helpful. But unfortunately, not everybody has that kind of mentorship.
Great. That's been great fun. Thank you very much for being here.
Pleasure. Thanks for having me.
It was a pleasure. And, well, we'll see you in the office.
Absolutely. Thanks.
Thank you. Before you go, we have a short announcement to make. Within a few weeks, we'll be interviewing a very established hedge fund manager in the US focusing on a merger arbitrage strategy. And we would love if you guys pitched in. If you have any questions that you would like us to ask, please email us at contact@thewallstreetlab.com and we will pick the best ones, mention your name, and ask them on the air. And one more thing, you can expect us to release a new episode on Thursdays every other week. So the next one is coming out on January 12th. Our next interview was a real treat for us, and if you are interested in fixed income investing, this is something that you should definitely listen to. Cheers.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.